The Federal Reserve is preparing a multi-trillion-dollar rescue package for the markets without making public statements about it. And all because one of the riskiest hedge fund deals on Wall Street is rapidly collapsing. While stock markets are in a fever amid the escalation of the trade war with China, which is rapidly becoming economic, a much more serious crisis is brewing behind the news noise. And it's in the bond market. But this problem is not just for Wall Street, the US Federal Reserve, or Donald Trump. Hedge funds are collapsing, liquidity is disappearing, and the Fed is having to consider opportunities to inject trillions of dollars just to stop this bleeding. But if this death spiral continues, we may see an increase in the number of bankruptcies, annihilation of pension savings, and even the threat of a new banking crisis that may affect you and your financial security. So how is the safest asset in the world? US Treasury bonds have become the epicenter of systemic risk for the whole world. What does all this mean for you and your financial future? And most importantly, how can we use this knowledge to protect ourselves before it's too late? So, in case you missed it, in the last video I talked about a large-scale vulnerability in the US Treasury bond market, which almost no one paid attention to. This is a nightmare situation, not only for Donald Trump, but also for the US Federal Reserve itself, as the dollar index is falling and interest rates are rising. Usually, stock market sell-offs, on the contrary, encourage its participants to switch to safe assets, such as gold and US bonds. And they are really moving into gold, given the growth of its value, but not into American bonds. After all, the yield of these bonds is not falling now. Now this usual rule has stopped working. Why? Because investors are moving away from the US and dollar assets. Minneapolis Fed President Kashkari calls this a global referendum on US hegemony. So, the US dollar is in free fall. It has already fallen by 10% from the January highs, while the yields of 10-year and 30-year bonds have jumped to 4.5% and 5%, respectively. If this does not mean a recession, it will certainly leave us on a direct path to the intervention of the US Federal Reserve. If we talk about hedge funds on Wall Street, they found themselves in a difficult situation due to the collapse of bond markets. Basically, they use a basic trading strategy, and it is based on the price discrepancy between the spot price and the futures price for the same bond. On this difference, they get their income. Usually this difference is very tiny, which forces hedge funds to use leverage. That is why, in order to increase income, they use huge amounts of borrowed funds. We are talking about a leverage of 10 to 1 and more. These hedge funds are betting hundreds of billions of dollars on what should be a stable and negligible price spread. In fact, hedge funds now hold approximately $1 trillion worth of bonds, which means that they control 11% of the entire bond market. If, due to market or financial conditions, hedge funds are forced to sell off their assets, for example, because of margin, this can lead to huge selling pressure on the bond market of about $8 trillion. Usually, when the stock market falls, we see an influx of money into bonds as safe havens. But the opposite happened last week. We did not observe the purchase of bonds, but their sale, which caused strong volatility. And for funds with a high debt load, even minor fluctuations are dangerous, and volatility of such a level as last week is fatal for them. So who is selling American debt and causing all this turbulence? This is where things get even more interesting. Someone says that China or Japan does it, and maybe it is. But in fact, there is an autogol situation going on here. The trade war with China and economic tensions are causing financial institutions, including banks that provide loans to hedge funds, to worry about the ability of these hedge funds to repay these loans. From this, creditors begin to withdraw their money or, more simply, withdraw liquidity. They also stop extending these loans and make margin demands that hedge funds should provide more collateral for their positions. And as you might guess, these over-leveraged hedge funds simply don't have that money. So what are they doing? They are launching their own loop of doom. They are frantically trying to get cash, and for this they sell off the only asset they have left, US Treasury bonds. In other words, we observed most of these sales not from China, Japan, or some countries, but firm hedge funds themselves. Yes, you got it right. The safest asset in the world, US Treasury bonds, are now being massively sold off by hedge funds. And such a sell-off creates what we have already seen before, a systemic risk for the entire financial system. This is the very term that became the reason why in the 28th year the US Federal Reserve decided to rescue banks. With the help of large-scale financial assistance, which eventually amounted to about $700 billion. That aid package was known as the TARP Trouble TS Relief Program. This is a program to help distressed assets. Only this time, there are two key differences. Firstly, this time it's not about banks, but hedge funds, and secondly, this time, instead of $700 billion, trillions of dollars may be needed to save the entire system. Do you think it won't happen? In fact, it happens again and again. First of all, 2 weeks ago, before Treasury bond yields rose sharply, financial experts and insiders had already called on the US Federal Reserve to create a special tool to rescue hedge funds. This means that the crisis did not come as a surprise to them, they foresaw it. And they already have a solution. These are the rescue programs from Fairer USA. Secondly, all this has happened before, for example, in the 2020 year, during the COVID pandemic. Financial markets experienced a sharp drop, and serious liquidity problems arose, including in the US government bond market. This caused a margin call on Treasury bond futures, which led to instability and large fluctuations in the market. What did the Fed do then? It has taken large-scale measures, lowered interest rates to almost zero to make loans cheap, and started buying assets en masse, including bonds. And in the end, it poured trillions of dollars into the economy and the system. Do you remember what happened with Bitcoin back then? It has grown from $3,500 to $69,000 per coin. Hedge funds are in almost the same situation now as they were during the coronavirus. And we know that the US Federal Reserve has saved them before, and we know how it did it, and what consequences it had for the market of risky assets, which Bitcoin is also. Third, if you need hard evidence that something is breaking right now, that it's not just temporary volatility, all you have to do is look at the so-called co-spread. This is a security overnight finance raid, a key indicator of stress in the bond market. When this chart falls, it means that banks are panicking, liquidity is running out, and that we are in big trouble. Let's take a look together. This is where you can see that this spread is falling to a record low, which means that the system is starting to choke. Simply put, money stops pouring into the system. Institutions sell off even high-quality assets just to get cash, dollars. This graph alone tells us the system is literally screaming that something is wrong. But what scares the most is that the process of forced liquidation of hedge fund positions has just begun. And the US Federal Reserve is cornered. Whatever you do, we lose. If they decide to save the hedge funds, we already know how it will turn out. Inflation will soar, the dollar will devalue, and we will pay for all this. And those who foolishly gambled with debt, IDS hedge funds, will get away with it again. All problems will be solved at our expense. But if the Fed takes too long to act, it puts the entire Treasury bond market at risk. In comparison, what happened on the stock market last week seems insignificant. We may see a serious collapse. 401k pension plans, pension funds, RA. All of these instruments are tied to bonds, and all of them will be under a serious blow. Lending may freeze, businesses will begin to collapse, and, of course, inflation will worsen, which may even turn into hyperinflation. And this means that the cost of ordinary life will skyrocket. And this is not even the worst part, because there is still one consequence that can change our lives forever. Now let's take a step back and look at the US situation in a global context. It is no secret that for many years the countries of the world have been gradually reducing their dependence on the dollar and reducing their dollar reserves, including treasuries. And I've been talking about it all the time on this channel. But now something has changed. Instead of slowly reducing their stocks or simply buying less, it seems that these countries have been given the green light to stop buying us treasury bonds completely. And a vivid example is China's recent decision. Maybe it's just that for the first time they have seen more reliable alternatives. Or maybe they are no longer afraid of retaliation from the United States. The US government sells treasury bonds at auctions to finance debt. A debt that, as we all know, costs more than $1 trillion a year just to pay interest. But what happens when the demand for this debt falls? The government is forced to raise rates to attract new buyers, and this makes debt servicing even more expensive and unstable. And right now it happened. This week, the auction of US Treasury bonds showed shockingly weak demand from foreign investors. And when foreign buyers do not come, guess who is obliged to lend their shoulder? Of course, American banks. This week, US banks bought as much as 0.27% of the total debt at auction, that is, almost a fifth. What does this mean? That means two things. The first one, the confidence of the world community in the United States in the dollar and dollar assets is weakening. And the second, American banks are now forced to hold all this unwanted debt risk themselves. Well, that's where everything becomes what in football is called an autogol. When banks are forced to redeem all these treasury bonds, what happens if their value falls? Of course, banks receive huge unrealized losses. They already had them, even the US Federal Reserve. But can they afford to aggravate these losses even more? But it is these institutions that are responsible for the security of citizens' deposits, for the security of their funds in their accounts. But they won't be able to protect them. That is why they changed the legislation. Now it's not them, but ordinary citizens who will do it. It is the people's money that, if necessary, will be used to patch up the holes. And this is not only happening in the USA. Pay attention, for example, to Europe. Amazing news, isn't it? 10 trillion euros of citizens' savings, if anything, can be used. Ask yourself the question, if the demand for treasury bonds continues to fall, and banks will be forced to continue buying them. How safe are deposits in these banks really? And before someone says, come on, it's impossible, it doesn't happen. Remember, this has already happened in Lebanon, Cyprus, Greece. And if someone says, but this is the United States, this is not Lebanon, this is not Greece, this is a big economy, that's it. This has already happened in the US too. Just a couple of months ago, a bank in Oklahoma, First National Bank, Lindsay, went bankrupt. It went unnoticed, but he was not saved, not redeemed. Even those who had more than $250,000 in their account were not protected. Despite all these insurance from the FDIC. Their money was used to cover the debts of this bank, and I didn't hear about it myself until one of his clients wrote about it. I believe that the states and the media did not advertise this situation in order not to cause panic. Since there is enough uncertainty now, you can tell, but they shouldn't have kept more than the amount covered by insurance. In the USA, the state insurance system FDIC covers only up to $250,000 per depositor in one bank. Everything above, not guaranteed. Usually, if a bank collapses, then over this amount, you can lose some of the money or wait for the return of this money for years. But in the case of, for example, Silicon Valley Bank, which, as you remember, went bankrupt in 2023, they made an exception. They returned everything to everyone, even what was not insured. However, this was the exception, not the rule. The story was too loud, and they didn't want people to doubt the safety of their money in banks. And not run to withdraw all their deposits from other banks too. In short, they did everything to prevent a chain reaction of banking panic. And I'm not calling for a massive withdrawal of money from banks right now, but I'm just reminding you that this is an event. This is just the tip of the iceberg. If you think that the FDIC insures amounts up to $250,000, think again. We have seen how events have developed in other countries. We know that accounts can be frozen for years. And what happens over the years? There is a devaluation of the currency, which means that even if you then get access to your money, they will be able to buy much less goods and services. And this is if this money is returned to you at all. If you still don't believe me, listen to Odessa itself. This is the Federal Deposit Insurance Corporation. At one of their private meetings, They laughed at the Americans because they do not know what bail-in is saving banks at the expense of depositors in these banks. They believe that the ignorance of Americans is better, because it's not worth scaring people. I think we need to take into account the unintended consequences if we start talking to a population that may have more faith in the banking system than we have in this room. These are the people who are responsible for the safety of deposits, and they do not believe in the banking system, apparently. Well, or at least, they believe in it less than the customers of these banks. Let's call a spade a spade. The state shifts its debt to the bank. Banks bear all the risk and burden of losses, and then, it is the bank's customers who become their insurance in case of collapse.